To the top picks from Gordon Reid, starting off with Elevance Health, big in health insurance. It used to be called Anthem.
It did, and referencing back to Barb's question on United Health, this is the company that I would prefer to United Health. It trades at about 5 or 6 multiple points cheaper than United Health. The growth metrics, I believe, are as good. It's treated us extremely well, our clients and myself, to be honest. So we're very high on this. It's got a demographic tailwind to it, of course. We're all getting older and needing more health insurance. And it trades at about 14 times earnings. It's got a free cash flow yield of 6%. So that's very attractive. So we think that Elevance is a really good core holding in a portfolio. And of course, it's the piece of it's a piece of the defensive side of your portfolio. So we're quite high on Elevance.
I'm just on my Bloomberg here looking at a 5-year comparative between Elevance and United Health. United Health marginally outperforming over that period.
Correct. Yeah. Which is fine. I like the risk profile of Elevance because of the fact that it trades at a much less expensive multiple. I think that's going to hold up well. Yeah.
General Motors.
Yes.
It seems counterintuitive in that a recession is not good for auto sales.
That's true. And without question, people who watch the show regularly could look into the television screen and say, you were early. We were. We didn't think that the recession or the negative market, not the recession, would impact GM and the other automakers as much as it has. But we're invested for the long term here, Andy. You hear that a lot, but it is true. And GM has all of the component parts to do well long term. First, on the fundamental side, they're looking to double revenues by 2030. That's a stated objective by Mary Barra. 25% of their, 40% of their offerings by 2025 will be electric vehicles. Electric vehicles are higher margin. They've got their costs under control. They're in a break-even situation at 10 million units per year over the North American car market. We're at about 13 or 14 million now. Normalized is about 17 million. So there's a lot of operating leverage that will come to General Motors as we normalize. They're right now making about $6, $6.50 a share at $35, less than 6 times earnings, and 5 times EBIT, enterprise value to EBIT. So a very inexpensive opportunity. And the cherry on this, Andy, is that they own Cruise, which is the autonomous driving operation. It's now live in San Francisco. It's live, I believe, in a couple of Texas cities. Austin, I believe, is one of them, operating taxi services. So you can, as an individual, not an experiment, not a beta test, you can order a taxi, it'll show up with no driver, you get in the back, and away you go. This is the future, and the pricing or the value of this opportunity has been pegged at around $30 billion. Well, $30 billion in the context of GM is somewhere around a third of their market value. Whoa. And the $30 billion isn't just a number we pick out of the air. They've had outside investors make investments in Cruise, including Microsoft, that have made investments that value it at those levels. So there's a huge amount of opportunity in electrified vehicles, in these car companies, and we'll be patient.
Okay. And what about Ford? Ford making this massive bet on an electric F-150. Do you like the look of Ford these days?
Well, there's a few things about Ford that I really like. They've got a great offering. They've got a refreshed offering, fresher than GM's, to be honest with you. But on the negative side, they don't operate as efficiently as GM. Their cost base is less efficient. Their operating margins are much lower. We've looked at both. You always do peer group analysis when you pick a stock. You always look at the competitors because you might like the stock, and then when you look at the competitors, you find you've got number 3 in the industry. So we always look at the competitors, and we've chosen GM.
GM has its own electric Silverado truck coming out, apparently. Morgan Stanley is your final idea here.
Yeah, Morgan Stanley, of course, historically has been a mergers and acquisitions, a capital markets company, highly cyclical, of course, but it's morphed into more of a wealth management company. They bought E-Trade, they bought Eaton Vance. 50% of their revenues now come from their wealth management area. So in this year where we've seen virtually no IPOs, M&A activity is very poor. Morgan Stanley's done quite well because their wealth management group's done well. They pay a really fine dividend, somewhere around 3.5%, 3.75%. But they're buying back a lot of stock with their free cash flow. They bought back 7% of their float last year, which when you factor that in with the dividend, gives investors about a 10% return on their capital. Well, they look at the company and say, can it improve? M&A is weak, but they're involved with the Tesla deal. That's going to pay them a lot of money, perhaps upwards of $1 billion.
Which deal, sorry?
That's the financing deal for Elon Musk to buy Twitter.
Oh, Twitter, yeah.
Yeah. So they're doing that deal, and M&A groups make between 1% and 3% of the value of the deal. It's a $44 billion financing. So, you know, if you do the math, that's somewhere between $500 million and just north of $1 billion. And this is on a $60 billion revenue base. So pretty significant, but in the meantime, their wealth management group is really helping them along.